Welcome to our CFP Exam Prep podcast focusing on retirement planning concepts, specifically comparing traditional and alternative retirement approaches. Let's break down traditional retirement first. Traditional retirement typically occurs around age 65, aligning with Social Security full retirement age and Medicare eligibility. This approach follows a conventional accumulation phase during working years, followed by a distribution phase in retirement. The standard retirement calculation assumes a 4% withdrawal rate from retirement savings, with adjustments for inflation. A common mistake students make on the CFP exam is misunderstanding how Social Security benefits interact with traditional retirement timing. Remember that taking benefits at age 62 results in a permanent 30% reduction compared to full retirement age benefits. Each year of delay until age 70 increases benefits by 8%. Alternative retirement strategies have gained significant attention, with FIRE being the most prominent approach. FIRE advocates aim to achieve financial independence through aggressive saving, often 50 to 70% of income, and reduced expenses. The goal is typically to retire in their 30s or 40s. This requires a different mathematical approach than traditional retirement planning. The FIRE calculation often uses a 3% withdrawal rate instead of 4% to account for a longer retirement period. Here's a practical example. A traditional retiree at age 65 with $1 million could withdraw $40,000 annually using the 4% rule. A FIRE retiree at age 40 with the same amount would only withdraw $30,000 annually using the 3% rule to ensure portfolio longevity. Students often struggle with questions about sequence of returns risk, which is particularly crucial for alternative retirement strategies. Early negative returns can devastate a portfolio during early retirement years. The exam frequently tests this concept through scenarios where retirees face market downturns shortly after retirement. Another key distinction is the role of Social Security. Traditional retirees can typically count on Social Security for 30 to 40% of their retirement income. FIRE retirees must plan for decades without this safety net, requiring larger personal savings to compensate. The exam often presents questions about health care coverage in early retirement scenarios. Traditional retirees have Medicare at 65, while alternative retirees must budget for private health insurance, which can cost $15,000 to $20,000 annually for a family. When studying for the exam, focus on understanding the different risk factors between traditional and alternative retirement. Traditional retirement risks include inflation and longevity. Alternative retirement adds risks like career reentry difficulties and social challenges of early retirement. Be prepared to calculate required savings rates for both approaches. Traditional retirement might require saving 15 to 20% of income, while FIRE strategies need 50 to 70%. The exam may ask you to determine the feasibility of different retirement strategies based on client scenarios. Remember that hybrid approaches exist. Some clients may choose partial retirement or phased retirement, reducing work hours gradually. The exam tests your ability to recognize when these alternatives might be more suitable than either traditional or full FIRE approaches. A critical concept is the relationship between passive income and retirement sustainability. FIRE strategies often emphasize building multiple income streams through rental properties, dividends, or business investments. Understanding how these income sources affect withdrawal rates and portfolio longevity is essential for exam success. Always consider tax implications in retirement planning questions. Traditional retirees benefit from lower tax brackets in retirement, while FIRE retirees may need more sophisticated tax planning strategies due to their extended retirement horizon and potential need to access retirement accounts early.